Historically, the return on the S&P 500 has outperformed many other assets, making stock investing a powerful tool to those wanting to expand their wealth. Here are the 6 simple rules to follow on how to invest in stocks for beginners. Number 6. Determine and understand your investment goals. It may look simple, but a lot of people begin investing in a trillion-dollar market without any form of strategy, which in essence is really just a gamble. You have to first define your goals in order to set realistic expectations and stop doubting yourself if you don't hit thousands of dollars in a certain period. For instance, your investing strategy will depend on whether you are holding it for the next 20 years or you want to lock in your gains in the next 5 years. There are things you need to ask yourself. How much of your time, knowledge, and focus are you willing to spend on your investments? Is there any specific stock or industry you are particularly interested in? You can look into individual stocks if you have the time and resources to dive into their fundamentals, as they can yield higher returns when you choose the right ones. Nonetheless, it is absolutely acceptable to choose a low-cost ETF or mutual fund as a starting foundation of your portfolio. You should also take into account if you are a value or growth stock investor. Half the battle is already won once you determine exactly what you are looking for. You will not fall into the fear of missing out mentality when everyone else is chasing the hottest stock in the street, only to find themselves in deep loss after the hype runs out. Number 5. Ignore the media noise. Buzz in the media is a highly influential player in stock investing that almost always has a detrimental effect on an investor's success. It often leads to a clouded judgment. It is typically led by stock experts who forecast the direction of a certain stock or the market in general. Let's get real. These media companies are businesses looking to profit to begin with. Newspapers and publications need readers, while television programs need viewers. The mainstream media constantly reminds you that long-term investing is old school, while they are here to provide you with a selection of great stocks to trade daily, weekly, or monthly. This tactic lures you to tune in more regularly or subscribe to the services they offer. This is not to say that all they talk about is rubbish, but keep in mind that if your investment goal is for long-term success, you should limit your exposure to them. Number 4. Do your own due diligence. Know what you are investing in. After all, this is your hard-earned money, so it stands to reason to do your homework before you invest a single cent. Whether your knowledge comes from watching videos, listening to podcasts, or reading articles, you'll be doing much better than the bulk of investors who just throw their capital to the markets. Although it can be beneficial to hire a financial advisor, it will always be in your best interest to spend the time to research and understand the stocks and industries you are invested in. Having a solid grasp of your stock portfolio helps you reduce your risk of falling victim to scammers and cheaters pretending to be experts. Number 3. The early bird catches the worm. Understanding both the power of compound interest and the difficulty of getting it is the heart and soul of understanding a lot of things. Charlie Munger. The earlier you start your investing journey, the higher your returns will be. That is the magic of compound interest. This is why Albert Einstein regarded it as the most powerful force in the universe. The compound interest that you will gain from your youth would make very handsome returns by the time you reach a certain age. For instance, if you started investing with only $1,000 at the age of 25, and you only contribute $365 every month, that yields 9% annually, which is the average return of the S&P 500 in the last 50 years, you would reach an impressive amount of $1 million by the time you hit 60. But if you delay to start investing at 30, you will need to fork out $580 each month to reach your $1 million goal at 60. Either way, this is an uncomplicated and painless way of building up a decent nest egg. If you are 25 and single, you won't have as much huge expenses to take care of and should be able to set aside some money for investing. Your obligations and liabilities will rise as time catches up, but the good thing is, so will your income. This way, you won't be too burdened by the regular monthly or quarterly commitments to your investing account. Number 2. Market crashes are your friends. Buy when there is blood in the streets, even if the blood is your own. Baron Rothschild. Bear markets are not to be feared of. Great wealth is usually made during downturns, as these present opportunities to buy stocks at discounted prices. If you purchase stocks or ETFs at reasonable or overpriced value when the market was going up, wouldn't you be happier to buy more when the market is going down and prices are falling? Having a strong gut during market corrections is one of the ways the rich get even richer, because wealth gets transferred from retail investors who panic sell to wise investors who go bargain hunting. Take advantage of these opportunities to purchase your favorite stocks, as long as their fundamentals remain solid. Before getting into number 1, make sure to hit the subscribe button so you never miss out on future videos. With that said, here is number 1. Keep track of your investments. Your investments are a product of your blood and sweat, so it makes sense to keep an eye on them periodically. You can do an annual review with your financial consultant, or take the time on your own to sit down and assess the fundamentals of your stocks and see if anything significant has changed. You should consider market trends to make sure the companies you invest in remain relevant or will soon be disrupted by innovation and technology. This may lead to some rebalancing in your portfolio to ensure that you are on track to meet your investment goals. Keep in mind that your objectives may change from time to time as you go through certain milestones, including marriage, raising children, a job loss, or nearing retirement. Along with these changes, your portfolio will also face some readjustments to strike the balance. Make sure to check out the next video, as you will surely get a ton of value from it. Thanks, and see you again.